My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? Just trying to make you some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. When everything's going down, you can't just stand there. You got to do something. Warren Buffett famously said that, unlike baseball, there are no called strikes in this business. And that is true to a certain extent. But as long as interest rates remain low, and even after this move, they're still low, I think you have to take advantage of declines like this and find something to buy. One of the babies that are getting thrown out with the bathwater? Why bother to buy anything after a day like today where the Dow lost 163 points, S&P declined 0.14%, and the Nasdaq had to mount a furious comeback just to finish up 0.05%? Many reasons. First, if you want to be a good investor, you need to buy stocks when you're getting low prices, at least low relative to just a week or two ago. Like when the market was in free fall this very morning. You had to buy the Nasdaq when it was its most ugly. In this sense, I think Buffett could be wrong. Maybe there are no called strikes in this business, but there are certainly missed opportunities. When you see a big decline like this morning in the Nasdaq, it sure feels like a called strike if you do nothing, and then the market goes right back up like it did today. We know that many people like to buy a rising market because they fear missing out. They're trying to buy high and then sell higher, but sometimes they simply buy high and get crushed. The thing is, if you buy now, you're buying low, or at least much lower than where we were a few weeks ago. That's how you can avoid kicking yourself for buying stocks near the peak. Even if we have more downside, at least you're not coming at the high, right? We managed to catch the low today for some of our buys for the investing club, my charitable trust, but that was because when things are most ugly, my discipline is to look at the ugliest stocks and the best companies. In other words, the stocks that are down the most of really good companies and do some buying, as Sarah Eisen told you when she recapped our move on closing bell today. Second, the leader on the downside in this market, the stock that started the whole decline, frankly, was Adobe, the $250 billion software titan. After getting, and it just has been hideous. After getting slammed once more this morning, trading as low as $497, Adobe finished the day up 3% to $525. I've chronicled this today. It was on Twitter, believe it or not. While this company is very profitable, when it reported mid-December, its results were widely panned. Since then, big tech has been wobbly. Then on January 4th, UBS slashed its estimate for Adobe and downgraded the stock, saying that the business isn't making a comeback. It's actually down-ticking. Now, I don't think that's necessarily true. Now, I had Adobe's CEO, that's Shantanu Narayan, on this show after the company reported. And Shantanu, well, I thought he said a lot of good things, and he doubted that there was any slowdown to begin with, let alone one that was continuing. I'm with him. Now, it's true there were some lines that weren't perfect. However, Adobe below $500, where it was at today's lows, is a very different beast than the Adobe that was at $680 a couple of months ago. In other words, unlike so many other stock pontificators, I think price matters, and it isn't factored in enough to people's thinking. It's no shock that Adobe turned today. It fell too far from where it was historically traded. Even if last week's downgrade was right, you're now getting in on a high-quality stock at a much better price, despite there being no real evidence that the business has deteriorated since they reported the quarter. Price matters. That's what you need to know when I say eyes on Adobe. Price matters. Third reason to hold your nose and buy, some very smart businesses are actually taking action here, which tells me that the lower prices are creating real bargains for other companies. Remember, there are two ways to value a company, based on what investors will pay for the stock and based on what another firm might pay for the whole enterprise. I famously told David Faber, my partner in the morning, a gazillion times, that it was too early to buy Zynga. That's that mobile game maker. I got less negative when the company turned profitable last year, only to see the stock plunge from $11 to $6 late last year. Now, again, that was that sell-off that began, right around the time of Adobe. I think the video game business is simply too competitive, especially on the mobile side. But today, TakeTwo Interactive bought Zynga. They bought it. Equivalent for nearly $13 billion in cash and stock. That's a 64% premium to where it finished last week. But it's still well below where it traded when the Nasdaq was still high-flying in the summer. Zynga's stock may not have been worth much to any given investor, but it was worth a great deal to another game maker that wants to smooth out its earnings, as Take-Two CEO Strauss Zelnick told us when I asked him about the deal this morning. Again, public investors aren't the only buyers out there. When a stock gets too cheap, another company might pounce. Sure, TakeTwo stock did get slugged on the news, plummeting $21. But you know what? I trust Strauss. He knows his business better than I do. Smart people taking action. A fourth consideration, when the stock market's taking its cue from the bonds, then it's possible that the decline can reverse if bond yields ever stop rising. We're all used to see stocks that can go straight down, but bonds tend to overshoot in a particular direction in given short periods, and then they correct in the other direction. Today we saw bond yields surge in the morning before going lower in the afternoon and finishing the session up very slightly. Now, that became a clarion call for traders to scalp or come in and buy the dip, usually with the intention of trading out at the end of the day. And by the way, the scalpers really won today because when rates turned, they continued to go down, and that gave you that window to buy. Now, obviously, the scalpers aren't the best kind of investors. They're traders. But they do show you that this market's interest rate sensitivity can cut both ways. And anyone who thinks rates can just keep moving inexorably higher simply has not studied the way the bond market works. To be sure, if rates go higher from where they are today, then same stocks that got crushed earlier this morning, will be beat up again tomorrow, except this time, investors will be looking to buy the dip, not sell it, because they saw what happened today. Fifth, the stocks that typically bottom first when they were in the throes of a decline, the food and drugs and consumer staples, all acquitted themselves well in the morning, as we would expect, giving you a sense that not everything would get obliterated. They don't necessarily produce a market-wide bottom, but you can pretty much can't have a bottom without them. They're the ones that always bottom first. Now, I actually worried this time that the playbook for them bottoming wouldn't happen because almost all of these staples have supply chain problems or raw cost issues. But the ones that reported keep telling me that they have pricing power coming in and the consumer won't resist the price increases. Decent place to be, or at least a place that is working, okay? When I say working, it means that, remember I told you Clorox had bottomed like 10 points ago? It's working right now. It's not where I want to be, but it's working. Now, there are a couple of things that still disturb me about this market. Many of the industrial winners have yet to really start coming down, although some did fall in the last 2 hours. We need them to go lower. In the end, everything corrects in an environment like this one. That's the last shoe. I also don't like how, well, two shoes. I don't like how the bank stocks are looking. Now, they are coming in way too hot into their earnings on Friday and next week. When that happens, unless the CEOs say, we are predicting a major earnings breakout because of the Fed, I expect the financials to pull back. Unfortunately, these are bankers, not tech guys. They aren't prone to making such bold projections. Meanwhile, financial technology, oh, my God, fintech, there really is no bottom. You know I follow PayPal. Charitable Trust owns it. It's been a mistake. The decline in the stock is horrifying to me. How low does it have to go before the sellers conclude that it's just no longer worth dumping? Not at these levels. Incredible. Now, the pattern in this part of the market is to rally off the lows and then open higher the next day, perhaps massively higher if bonds keep rallying, rates keep going lower, before coming in a bit between 10:30 and 11. And that's what makes things so hard. If it opens up tomorrow, it's very difficult to figure out what to do. It's another reason why I keep stressing you need to do buying into the weakness of ugly days like today, like my charitable trust did. So the bottom line, if the market opens down tomorrow, you should look for something to buy. But if it opens higher, take a pass. But remember that when an important index like the Nasdaq trades at a 3-month low, you have to at least buy something that's being thrown out because they can't all be that terrible. Mark in Connecticut. Mark.
Yes, Jimmy, chill.
Yo.
I got a show idea for you, and then I got a couple of stock picks.
Okay.
First show idea is you do a segment once a week called Do the Math, where you show us how to value different companies, like, say, Five9. You do 1 week. The next week, you do a bank where you show us how to do the price to book.
All right. I think that, remember, a lot of what I do is try to be as accessible as possible. I like that idea to try to figure out what the book value is versus, say, Citi and owning the stock. We've done it a couple times. It is, I try not to bore people, candidly. It's harder to understand. I try to put some sugar in it so that people like it.
It's a stock picker's market right now.
Well, true,
right?
But again, I got to try to educate. And it's like when I took the bar exam. You took the bar exam as a dry subject. You had to make it come alive, and those professors made it come alive. As far as Five9, you know that we have liked it. We've had trial upon. We think it's terrific, Mark, and I'm not going to back away from it. That's the one that Zoom Video tried to buy. Let's go to Kate in Georgia, please. Kate.
Hi, Cramer. How are you?
I am good. How are you, Kate?
I'm good. First, I want to say, I've made several wise, sound decisions, and there's a direct correlation of being part of the investment club.
Oh, that's terrific. Thank you. Thank you. We sure are trying. We're out there. But that's great. And I want people to join. It's very important to me. So go ahead.
So a while back, my son asked me what stock he thought, I should recommend for him. And I liked ISRG, Intuitive Surgical. And I said, let me see if I can do a little bit more due diligence. And I was blessed enough to come on the show and ask you about it. And you recommended it as a buy. And he got it, and I got more of it. But it's gone down. And I feel like we're moving well through the pandemic. I mean, I know things are rough right now, but I feel like things are going to get better and elective surgeries will go back up again. And I'm wondering if this is a good place to add to my position with it.
Yes, I think you've got this right, Kate. I think that is a stock that's been hurt by COVID because people don't go in and use the procedures because they're worried about getting it. That as this peaks, ISRG is going to be a stock that goes back up. Fortunately, not that much off its high, but just enough to really make it tempting because it's about a little bit more than 10%, which is perfect. Now, if the market opens down tomorrow, you got to look for something to buy. Okay? I mean, you saw what happened today. If it opens up higher and interest rates start going higher again, well, then you're going to have to say you missed it. On Mad Money tonight, analysts are rolling out their full-year outlook notes for 2022. And one name continues to be repeated among the crowd. I'm taking a closer look at Uber and sharing if I think this is the stock to buy for the new year. Then this weekend, sports betting became legal in New York State. So could some winners emerge on Wall Street after the group's decline? I'll give you my take. And Dexcom slipped today after reporting preliminary fourth quarter results. I'm going straight to the source to get a read on an amazing stock and a great company, the diabetes equipment maker that I think is just so good, Dexcom. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.